Hello, we are DST Investments, a consulting service provided by NAMCOA, a registered investment advisor also known as an RIA. NAMCOA provides real estate investment advisory consulting services on 1031 and 1033 exchanges and Delaware Statutory Trusts, which are most commonly known as DSTs. Today we are going to discuss 1031 exchanges, commonly known as like-kind exchanges or 1031s, and how they can be a smart tax strategy for business owners who also own and invest in real estate. Having a professional advisor assist you throughout the process and understanding just 12 fundamentals elements of DST 1031 exchanges will make you more informed to know if a 1031 strategy will fit into your overall tax and real estate plans. We can assist in balancing all aspects of the exchange and acquisition. We conduct due diligence on DST sponsors, provide portfolio modeling, and other consulting services on 1031, 1033, and opportunity zones. Our objective is to achieve portfolio diversification by geographic location and asset classification. In today's market, your businesses held real estate for some time. Chances are you will most likely have a capital gain in addition to depreciation and recapture, which is subject to a 25% tax rate upon sale. This could possibly be higher depending on your state of residency. It often adds up to a large tax liability and subsequently less proceeds of the sale to reinvest in the purchase of new real estate assets. With a 1031 exchange, the IRS allows you to defer the tax liability on the sale of real estate assets used in a business that are held for investment until the replacement property is ultimately sold. Let's illustrate with an example. In this scenario, a $5 million building has been depreciated by $3 million over time, making the tax base $2 million at the time of sale. If the building is sold for $8 million, there is a $6 million gain, which includes a $3 million depreciation recapture at a 25% tax rate. Without a 1031 exchange, the $6 million gain will be taxed as follows. First, the $3 million gain is taxed as unrecaptured at IRS Section 1250 rates of 25%, which equals $750,000. The remaining $3 million gain is taxed at capital gains rate of 20%, $600,000. For federal purposes, if you're a passive investor, a net investment income tax of 3.8% is also included, which is $228,000. If we take an average state tax of 5%, that would be an additional $300,000. So the total tax bill is $1,878,000. Rather than having the $8 million in cash, you are left with only $6.1 million of cash after taxes are paid. But successfully executing a 1031, you could take the entire $8 million to reinvest into a new property. You may be asking, how long can one defer this tax liability? The second fundamental element deals with succession planning. If you have completed a 1031 exchange throughout your lifetime, the taxes will be due upon the ultimate disposal of the property. But if you can hold the replacement property or do subsequent 1031 exchanges on future sales, when your successor ultimately inherits the property, they will receive a step-up in basis equal to the fair market value of the property at the time of death, and the deferred gain is never recognized. Another strategy used for succession planning is using a 1031 exchange to change the asset's class. Investors who want to retire or leave real estate to their heirs who will not be active in the real estate business can trade into a property with a lease that has minimal management responsibilities. There are opportunities in the market that require actively leased, cash-flowing properties that allow for a passive approach. We often assist clients with asset management of their real estate investment portfolios to truly make these more passive investments. By deferring the tax liability, you'll have additional capital to redeploy with the purchase of larger or even multiple assets to increase your return on investment or diversify your portfolio. Now that you know some of the benefits of a 1031 exchange, the next question is, how do you go about it? There are some rules that must be adhered to and are best left up to professionals who handle many of these per year. Here are some rules and guidelines. Both the property that is sold and the replacement property have to be held for productive use in a trade or business or for investment. You cannot use a 1031 for flipping property or inventory property. With the new Tax Reform Act that passed in December of 2017, only real property qualifies for a 1031. This means that personal property, intangibles, art and collectibles, equipment, and airplanes no longer qualify for 1031 exchanges. You will want to check with state law on what qualifies as real property. The taxpayer who sold property must be the same taxpayer who purchases the replacement property. Furthermore, there are requirements on using all the cash proceeds, as well as replacing the debt component. For more information on this, please contact us for a consultation. The 1031 exchange timing is critical. You have 45 days from the close of sale on the relinquished property to identify 3 potential replacement properties. There are 3 methods of identification that an investor can employ. The first is the 3-property rule. An investor can select up to 3 properties. The investor can purchase more than one of the properties on the identification list to complete the exchange, as long as it's for an amount equal to or greater to the relinquished property. This is the most common method for identifying replacement properties. The second is the 200% rule. You can identify an unlimited amount of replacement property as long as it doesn't exceed the total value of 200% of the relinquished property sold. And third, there is a seldom used 95% rule that allows investors to identify as many properties as you wish with the value that can exceed 200% as long as you close on 95% of those properties. Another consideration is that after closing of the relinquished property, the 180-day rules start counting down. You have 180 days from the sale of the relinquished property to close on the replacement property. With today's market conditions, we strongly advise having the replacement properties identified in advance of the front-end sale, relinquished property, to be able to conform to these time requirements. This is a graphic illustration of the time periods you need to be aware of. There are no extensions to the 45-day identification period. The qualified intermediary must have your replacement list by the 45th day, and there will be no extension to the 180-day rule, even if the 180th day is a weekend or holiday. In that case, the closing would need to be before the 180 days. The fatal flaw on a 1031 is that you cannot touch the cash. By law, you cannot touch the money. A basic fundamental element of a 1031 exchange is that you must use a qualified intermediary, or QI, which can just cost a few $1,000s. Essentially, they handle the transfers of funds so the cash never touches your hands. A title company, attorney, or escrow agent cannot hold the funds for you. It must be a QI. There are several important reasons why those seeking 1031 replacement properties consider, then use a DST. With a DST, the 1031 has no tenants or other property management responsibilities. These are all handled by institutional property managers, supervised by a manager. This is attractive for real estate investors who want to keep their tax benefits intact, but no longer want the hassle of day-to-day property management or dealing with tenants. There are also other reasons why those seeking 1031 replacement properties consider, then use a DST. A key reason is diversification. By diversification, we mean not just by property type, but also geographical location and among more than one DST sponsor. DST investments can be as little as $100,000, opening up many options to diversify an investor's holding into several properties of same or similar types around the U.S., while still keeping intact their tax benefits. Another reason why those seeking 1031 replacement properties consider, then use a DST, is non-recourse debt. Many investors who are selling a property and are considering a replacement property may not want to take on more mortgage debt on their balance sheet. With a DST, all debt is non-recourse, meaning no personal guarantees and other potential clouds on their personal balance sheet. It's important to note also that some DSTs are designed not to have any mortgage debt or very little, keeping risk minimized and allowing for other planning. DST offerings are structured and offered as securities under the Securities Act of 1933, which requires the investor to be provided with a private placement memorandum or PPM. The PPM discloses various risks, fees, and expenses associated with the 1031 exchange and a DST investment offering. The PPM will also outline that potential investors must be accredited, which means they must have a net worth of $1 million or more, not including their primary residence, or have an income over the last 2 years of $200,000 for an individual or $300,000 for a couple. Business trusts and other entities may also qualify as accredited. Accordingly, the investor can now enjoy the best of both worlds, the disclosures of a security and the tax advantages of real estate. The last point to consider is, do you want a fiduciary in your corner to help you through the transaction, or a commission-only transaction person? At NAMCOA, we are a registered investment advisor that does consulting through DST investments in the area of 1031, 1033, and DSTs, as well as opportunity zones, OZs. Let our decades of real estate experience be placed in your corner. Do you need assistance with the 1031 exchange, or do you have a question regarding commercial real estate? Give us a call or email at support@dst.investments. This video is not a complete explanation of all 1031 scenarios and does not contain all the details of any particular DST investment. As prescribed previously, those details would have been outlined in a private placement memorandum. Please let us know how we can assist you. For more information on current DST opportunities, or if you are within the 1031 identification process, please contact us as soon as possible to review your situation and financial objectives. Thank you for listening.